After a great start to the year, equity markets have started faltering. What's in store for us ahead? How are India Inc. results shaping? And of course, amidst elections, can we expect volatility? Here's Harsha Upadhyaya, the Chief Investment Officer for Equities with Kotak Mahindra Asset Management Company Limited. Hi, Harsha. Let's start by talking about what we have been witnessing in the last couple of weeks. A bumpy ride of sorts for the equity markets. What's your take? And what are you witnessing in terms of factors that are moving the markets?
Yes, when you look at it from a short-term perspective, I think the volatility has increased. I think a couple of factors, more than local factors, it's been the external factors which have been affecting Indian equities as well, in our opinion. For example, there was a consensus opinion that inflation will come off and quite rapidly in the US market. And as of now, if you look at the past several months, inflation continues to be sticky. So there is a question whether there will be interest rate cuts at all during this year, although the consensus says that there could be one interest rate cut somewhere during the year. So that's one significant change that has happened compared to where we were, let's say, a few months earlier or a few quarters earlier. The second is the standoff between Iran and Israel, whether that can escalate into a bigger conflict. That was also on the minds of most investors during that period. Although I can say that after having seen last couple of weeks where there has not been any escalation, I think that concern is also behind us, at least for the moment, looks like. That could have had a bigger impact on crude oil prices, which anyways have a significant importance as far as Indian economy is concerned or Indian corporate margins are concerned. I think these were the two important external factors which led to some amount of volatility during the month. But I think this is par for the course. I mean, if you're in equities, you should be ready to withstand some of these events which can come at any point of time.
Now, we're in the midst of the results season, the penultimate quarter of FY24. Not all companies, of course, have delivered their results. In fact, not even half of them. But still, the big ones have, IT, etc. What do you make of how companies have fared so far?
As far as Jan to March quarter is concerned, it was supposed to be lower on year-on-year growth as compared to previous couple of quarters, simply because last quarter had a high base. So to that extent, while we still expect about 20-21% year-on-year growth for the full year in financial year 24, we are expecting just about 6 to 7% year-on-year growth when it is about Q4 of financial year 24. Now, as you rightly mentioned, out of the Nifty basket, about 40% of the companies have announced results. Those results, at least on the headline number side, they have been better than what the expectations were. While the entire basket was expected to grow at about 6 to 7% on a year-on-year basis, this basket of 20 companies were expected to grow at about 8.5% on a year-on-year basis. Those have actually delivered 11.5% growth. So overall, on the aggregate numbers, even the early part of the earnings season has been slightly better than expectations. But yes, within that, there have been few sectors which have continued to disappoint. For example, as you mentioned, IT continues to disappoint. FMCG results have not been so great. However, there are other sectors which have been either in line or better than expectations. The banking results were slightly better than expectations, I would say. Similarly, auto results were also better. So it's been a mixed bag, but at least on the headline numbers, we've been better off as compared to expectations as of now.
We're in the thick of elections. A part of India has already gone and cast their vote. Do you expect some sort of volatility to kick in the markets?
It's always difficult to predict short-term movements, but looking at what has happened during the first two phases, there has not been much of the volatility, especially because of the election event. So it remains to be seen whether there will be more volatility as you go towards the end of the election phase. But anyways, I think the next data point that can give some color to the market would be on the exit poll day, which is anyways almost a month away. And between the exit polls and the actual results, there is only one trading session. So to that extent, it's unlikely that it will lead to too much of volatility in the market. But anyways, I mean, as equity investors, one should be ready to face some of these volatile events. So I would say that the long-term investors need not worry. But if somebody is trying to time the markets, it can go either way.
And finally, to sum up our conversation, what's your advice for equity investors?
We continue to recommend that investors should be continuing to look constructively at equities. So overall portfolio should continue to be invested in a staggered way and with a tilt towards large cap funds. So overall diversified portfolio for equities, but with a slight tilt towards large cap is what we are advising. If you're looking at lump sum investments, maybe investing even in large cap funds at this point of time may not be a huge risk. But if you're investing into mid and small caps, maybe it's better off only through staggered investments. And as far as thematic exposure is considered, we are suggesting manufacturing as a theme, which can really do well over the next 5-7 years in our country as a theme for investment. So overall, diversified equities with a large cap tilt, and better to come through staggered approach. And if you want to take a thematic exposure, then I would say manufacturing as a theme.
Thank you, Harsha, for that. A tilt towards large caps and invest in a staggered manner. That's the word of advice coming in from Harsha Upadhyaya. Thank you for watching. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.